let's move into I want to talk a bit about the government debt. That's something that I think is crucial, and because I want to spend a bit more time and speak to you all directly. I did not actually what we call put it as something that I want to discuss just write in a report without sending you guys. So at least I want to present to you. That's the reason why I delayed that news to share with you all on Monday. Okay. Now the Fitch rating, what they did was they downgraded the US government credit ratings from AAA to AA plus. Now this is not good for the US. I have to be serious. This is not good for the US because that debt currently the US debt is about US dollars 33 trillion. And when you downgrade the ratings, what you have is that the US would need to spend more interest as their risk is now higher, right? So if the bank, like for example, a bank, they loan you money, but they look at the credit rating and you are of a higher risk, and to take on your risk they will charge you higher. So same thing with here. Now if you have a downgrade in US, that's exactly what's going to happen. The US will have to spend more money servicing their interest, right? Now if they have to spend that extra money servicing their interest, what does that mean? They have less money to spend on programs like Social Security, welfare, and other government programs. So if you look into detail, the Congressional Budget Office estimates, right, interest payment this year in 2023 for the US is estimated at US dollars 650 billion. That's really, really, really a lot. Now, this kind of downgrade that's happening to them, this magnitude of a downgrade, because you have to know that Fitch is a very respected institution, credit rating institution. So this kind of news coming out, this magnitude, can actually cause the Democrats to lose the coming election, the presidential election. And of course, the Biden administration is going to react. I don't expect them to just sit down quietly and not say anything. And true enough, the US Treasury Secretary Yellen criticized Fitch by saying Fitch used a flawed methodology to derive their conclusion. She also said the economy is resilient, and Fitch did not take this into consideration when, giving a credit rating to the US. So that is not right. That's according to her, right? So anyway, the Biden, administration overall insinuated that the downgrade was politically motivated and orchestrated by former President Trump and the Republicans. So we're going to have more political fighting going on forward for this until the presidential election is over. Now, for us, I think it's pretty straightforward. Make it simple. Go to Fitch Rating website. And when I went there, I looked at the reasons why this downgrade happened. Now, this downgrade is based on a few things. Now, the concern of Fitch with the tax cuts, overspending habits, political gridlocks. Now, when you talk about political gridlocks, it's something like the debt ceiling negotiations. And we all know very well in the next 2 years, there's going to be another negotiation coming up. And of course, we all know economic concerns. Now, according to Fitch, the US ability to service its debt is questionable with current government policies. Now, a deep dive into it, you will see one thing. For the fiscal year 2023 July, the US government has collected from taxes and other sources about 3.41 trillion US dollars. Now, if you will compare last year, the revenue was actually 3.84 trillion for the same period last year. So what it really means right now is actually a decrease of 423 billion US dollars. Okay, that's income, less income than last year. Now, let's just jump forward, look at the spending instead. Now, what you have over here, the US government, on the other hand, has spent 4.81 trillion in the fiscal year of 2023. Now, compared to the federal spending of 4.35 trillion for the same period last year, the federal spending has increased by 455 billion. So you see, you have earnings dropping compared to last year, but the spending increased last year. So what's really happening? That's the reason why Fitch is concerned, because look at the spending habits. It is going out of hand. Tax cuts are really happening, so that reduces income. And to top that, you have the politics not really stable, and the stable politics has been the reason why the most of the countries actually chose the US to be the US dollars to be the reserve currency, because there's political stability. Now, if that is called into question, then things might really change. Okay, all right. So now, if you look at the spending habits, right, you have earnings less than income. How long is it going to last? Okay, that this relationship, earnings less than the earnings is less than what you earn is always less than what is or less than what you spend. When you have that, can only mean one thing: debt can only go higher and higher from here. Now, with every debt ceiling increment, 1 to 2 trillion US dollars is added into the total debt. Now, this is, for me, I'm just using a very how do you say it? A modest, yep, that's the word, the right word. A very modest increment actually can be more than 2 trillion US dollars. So if you look into it, Fitch is just really calling out what they see, especially when both sides will come to a heated debate again at the next debt ceiling, which is estimated about 2 years from now, right? So with the current spending habits, if Biden were to spend more, I think it will even be faster, much faster. So the conclusion can be only two ways, and it's a dilemma for the US. First, either they can choose to print more money to service the debt or cut down spending drastically. The former, which is print more money, that will weaken the US further and trigger future inflation. But if they choose to cut down spending, then Biden and the Democrats may lose their leadership. Either way, it's a very tough thing, and they have to deal with it, whether they like it or not, right? Now, finally, Fitch is calling out a recession to happen in Q4 2023 or Q1 2024, citing tighter credit conditions, weakening business investments, and a slowdown in consumption. They, however, think it would be a mild recession. So what do you think? I would be happy, it would be good if you can share your thoughts too, and see, would we have a recession or not in the end of 2023 or early 2024. I don't know what you believe in. Yes. Feel free to share your ideas right over here. Okay. So that's why I've been saying, you just can't deal with a market that's going up with high interest rates going up at the same time. Something is going to has to give way. Okay. Now, what's going to give way? Let's look into the jobs market. First thing first, now non-farm payroll came in below 200K at 187K for the first time in a while. We haven't had a sub 200K for some time already. But what was surprising actually wasn't this sub 200K result here that we just had last Friday, but a revision of previous month non-farm payroll from 209,000 to 185,000. And that's even lower than this month's 187,000. Okay, so what we have here is we have 2 consecutive months of sub 200K non-farm payroll numbers. Now, does this really herald the cooling in the jobs market? Now, personally, I don't think it's enough. Even with the jobs report missing expectations right over here, I think the jobs market is still very, very strong. Okay, we have unemployment rate falling at the same time. When the news came out, we saw that unemployment drop, and not only that, the wage growth is stronger than expected. So at the end of the day, I think the ING sums it up perfectly for Friday's job data. A mixed outcome which doesn't rule out further rate hikes from the Federal Reserve, but doesn't give the central bank the all clear on inflation risk either. So again, we have a news that's neither here nor there. And that creates a lot of uncertainty. Now, when you have uncertainty, that is a headache that people need to deal with, right? So those kind of things that we need to look into detail when we look into the US jobs market update right over here. So that's one. So what I did was that I put out the table right over here. So when you see this table right over here, what we have over here so far is two news that's not showing a hike. Now, this is a very basic one. I will review again overall when we have more data. When we talk about more data, possibly is the August, when we have the entire news of August coming out, then that will be the best. Okay, so but right now what we have over here is still too early to determine. Very, very early, still too early to determine what would be the right thing. Okay, so wait a bit. I think the entire August we will have better results, but right now what we have here is a balanced result. 2 no hikes and 2 with hikes. So we'll see as we collect more data, then I think things will be clearer. Then we will jump in and we'll see more.